Hello and welcome to the 17th lecture of the course Forex in 3 steps. Last lecture was an introduction to fundamental and technical analysis. Today in this lecture we will be talking specifically about fundamental and news analysis in Forex. So we mentioned that fundamental analysis is basically studying and analyzing economics, politics and news. So what is economics? Economics is the science that studies how limited resources are allocated to meet the diverse needs of humans. There are two branches under economics. We have macro and microeconomics. Macroeconomics is basically analysis that studies the economy as a whole, such as GDP, inflation, unemployment, and fiscal and monetary policies to assess the overall economic performance. It also includes political influences which play a key role in guiding the economy. What is positive trade balance? The things we are about to learn now will help you with your fundamental analysis, because part of the fundamental analysis is knowing which countries and which stocks and financial markets are the best to invest in right now. So for example, there are countries that are very good when it comes to investment wise, and there are countries that you should not be investing in. And positive trade balance is an indication that a country or a certain financial market is good to invest in. So positive trade balance it occurs when the value of exports is greater than imports, which means we have an increase in exports, we have increase in company production, the country has a rise in employment and lower unemployment. It also means that we have an increase in international monetary reserves, and it also means growth and economic recovery of the country. And all of these are very positive indicators, which means that a country with positive trade balance is a country that has potential, and it's a good opportunity to invest in. Exporting or producing countries always have a positive trade balance, such as Japan and China. They have a large trade surplus. They attract foreign companies due to cheap labor, and they always seek to keep its currency low to boost exports, but within reasonable limits. And that is why these countries are very good when it comes to investments. Now let's take a look at the companies you should not be investing in their stock market and in the countries. Negative trade balance. Negative trade balance occurs when the value of imports is greater than exports, and this leads to a decrease in exports. It leads to low company production, fewer employees and higher unemployment, decrease in international monetary reserves, and it also means that there's a slower growth and economic contraction of the country. And as you can see here, the exports are much heavier than the imports, which means that the exports are way higher. Now let's jump into some of the more important types of economic indicators that you will need to know in order to be able to make good and decent fundamental analysis. The first thing is the GDP, or in short it's GDP. It is called gross domestic product. It is basically the value of goods and services produced by a country within its borders during a specific period of time. We also have gross national product, which is GNP. It is the value of goods and services produced by a country, both domestically and abroad, by its citizens during the same period. These two terms are very important, and it is very important to know what they indicate and what they mean, because fundamental analysis requires you to understand what's happening around the world, in the country, economically, politically, everything. What is a general budget? It is a financial plan prepared by the government to determine the expected revenues and expenditures during a fiscal year, aiming to manage resources and achieve economic and social objectives. Under the general budget, we have two types of budgets: a budget deficit and a budget surplus. A budget deficit means it occurs when the government expenditures exceeds its revenues, forcing the government to borrow or reduce spending. Budget surplus, it occurs when revenues are greater than expenditures, which is a positive indicator of efficient financial resource management. So by understanding this, it is definitely better to find countries and financial markets with a budget surplus. Inflation, you may all be very familiar with inflation because it is one of the most important things in life. It is a general and continuous rise in the prices of goods and services, leading to a decrease in the purchasing power of the currency. This is also something that is important to be able to know fundamentally, especially when trading the Forex markets. We also have foreign exchange reserves. It is the amount of foreign currencies held by a country, usually through the central bank, to support its local currency, repay debts, and finance imports when needed. T-bills and T-notes are also something fundamentally very important when investing and trading. T-bills are short-term debt instruments issued by the government to raise funds from investors, repaid within less than a year, usually without direct interest but sold at a price lower than their face value. T-notes, on the other hand, they are debt instruments issued by the government with a maturity period of 2 to 10 years, paying a fixed interest coupon every 6 months until maturity, after which the face value is repaid. You should also be familiar with currency floating and credit rating. Currency floating is allowing the exchange rate of the currency to be freely determined by supply and demand in the market without direct intervention from the central bank. Credit rating, on the other hand, it is a rating given to a country or company that determines its ability to repay debts, conducted by institutions such as Moody's and S&P. The higher the rating, the lower the risk. So it is definitely a good thing to invest in countries and stock markets and financial markets with a higher credit rating. Recession is also recession and depression are also something that is very popular with the economic world. Recession is a slowdown in economic activity that lasts for 2 consecutive quarters, 6 months. A quarter is 3 months, so 2 consecutive quarters means 6 months, characterized by decreased production, rising unemployment, and reduced spending. It is the depression, on the other hand, it is a more severe and prolonged form of recession, marked by a sharp economic contraction, major market collapse, and extremely high unemployment, which may last for years. Depressions have happened over the years. There are some very famous depressions that happened in the economy of the world, and they were definitely tough times. Deflation. Deflation is a general and continuous decline in the prices of goods and services, leading to an increase in the purchasing power of the currency, but it may cause economic recession due to reduced spending and investment. Financial crisis. It is a more severe and prolonged form of recession, characterized by a sharp economic contraction, major market collapse, and very high unemployment, which may last for years. Economic crisis. It is a state of widespread economic collapse that includes deep recession, high unemployment, and a decline in national output, which may result from a financial crisis or other factors such as wars or disasters. And that is the end of the introduction to the fundamental analysis. These things and these terms are very important and you should be very familiar with if you want to proceed and learn fundamental analysis. See you in the next lecture.